This is Wallet Brief, where we break down what actually moved the U.S. economy this week, without the noise. If prices, interest rates, jobs, housing, or taxes are quietly changing your money, this is where you stay informed. Let's get into what really happened this week and what it means for your wallet. The housing market has been in a complex adjustment phase since late 2025. Over the past 3 months, we've seen mortgage rates stabilize between 6.8 and 7.2%, a significant shift from the volatile swings of 2024. Meanwhile, home prices have shown regional divergence, with coastal markets cooling while Midwest and Southern markets maintain steady, modest growth. Rental markets have been particularly active. National average rents plateaued in December 2025 after 18 months of increases, but supply constraints remain tight in major metropolitan areas. Construction permits showed mixed signals. Single-family permits declined 8% year-over-year through January, while multifamily permits increased 12%, indicating developers' response to rental demand. The Federal Reserve's housing-focused commentary has emphasized monitoring shelter costs as a key inflation component. Before this week, housing represented roughly 35% of core consumer price index calculations, making any significant moves critically important for monetary policy. 3 major developments shaped housing markets this week. First, the Federal Reserve's Wednesday meeting minutes revealed explicit concern about persistent housing cost inflation, with officials noting that shelter costs remain stubbornly elevated and could influence future rate decisions. This marked the first time since September that Fed officials specifically highlighted housing as a policy priority. Second, the Commerce Department released January new home sales data, showing a 6.3% monthly increase, the largest gain in 14 months. Median new home prices dropped 3.2% month-over-month to $489,000, suggesting builders are adjusting pricing strategies to clear inventory. Importantly, sales increased across all 4 major regions, indicating broad-based improvement rather than isolated regional strength. Third, the Mortgage Bankers Association reported that refinancing applications surged 28% week-over-week, the biggest jump since October 2025. This followed signals from 2 major lenders that they would reduce mortgage rate spreads, effectively lowering borrowing costs, even without Federal Reserve rate changes. Purchase applications also increased 11%, suggesting genuine buyer re-engagement. The housing market is showing early signs of stabilization after months of uncertainty. The combination of builder price adjustments, mortgage market improvements, and steady buyer activity suggests we may be entering a more balanced phase rather than the boom-bust cycles of recent years. However, this stabilization comes with important caveats. Regional markets continue to diverge significantly. While national trends show improvement, markets like San Francisco and Seattle continue experiencing price pressure and inventory shortages. Conversely, markets in Texas, Florida, and North Carolina are seeing both inventory increases and price moderation. The Federal Reserve's explicit focus on housing costs signals potential policy implications. If housing cost inflation persists, it could influence rate decisions even if other economic indicators suggest easing. This creates a feedback loop where monetary policy affects the very housing costs the Fed is monitoring. Most critically, the recent mortgage market improvements appear driven by lender competition rather than fundamental rate changes. This suggests potential fragility. If credit conditions tighten or economic uncertainty increases, these improvements could reverse quickly. For current homeowners, this week brought mixed financial implications. If you're considering refinancing, the recent rate improvements create a window of opportunity, but remember that rates remain significantly higher than the pandemic-era lows. A refinance only makes sense if you can reduce your rate by at least 0.75 percentage points and plan to stay in your home for several years. For renters, the stabilizing sales market could gradually ease rental pressure, but don't expect immediate relief. Landlords typically adjust rents based on broader market conditions with a lag time. However, increased multifamily construction could begin affecting rental supply by late 2026, potentially moderating future rent increases. Prospective home buyers face a complex decision environment. While new home prices have moderated and sales activity increased, Mortgage rates around 7% still represent significant monthly payment increases compared to recent years. A 400,000 home purchase now requires approximately $2,650 monthly for principal and interest, compared to roughly $1,900 at 2022's lower rates. For your broader financial planning, housing market stabilization reduces one source of economic uncertainty. However, the Federal Reserve's attention to housing costs means future interest rate decisions could significantly impact not just mortgage rates, but also credit card rates, auto loans, and savings account yields. Next week brings critical housing data that will clarify whether this week's improvements represent genuine trend changes or temporary fluctuations. Tuesday's existing home sales report from the National Association of Realtors will show whether the new home sales improvement extends to the broader resale market. Wednesday's mortgage rate surveys will indicate whether lender competition continues driving rate improvements or if rates begin reverting to recent averages. Pay particular attention to the spread between 30-year fixed rates and 10-year Treasury yields. A narrowing spread suggests sustainable improvement, while widening indicates temporary market dynamics. Friday's housing starts data will reveal whether builders are responding to recent sales improvements by increasing construction activity. Rising starts would suggest confidence in sustained demand, while flat or declining starts might indicate caution about future market conditions. Most importantly, watch for any additional Federal Reserve officials' commentary about housing costs and monetary policy. Given this week's explicit focus on shelter inflation, any further guidance could significantly impact mortgage markets and broader housing sentiment. That's your wallet brief for this week. These changes don't always make headlines, but they do change how much you pay, save, and earn. We'll be back next week with the updates that matter. Until then, stay informed and protect your wallet.